In this video, we're going to continue some discussion on the weighted average cost of capital. And there's really two steps. Number one, we need to conclude talking about finding the cost of the sources. And the source that we're going to be concluding our discussion with is using equity to help finance the company. And then we'll discuss in general about the use and formula for which to calculate the actual average cost of capital of the sources. So if you think about common stock, there's really two ways a company gathers financing from common shareholders. The first is the easiest to think about, and that's really the issuing of common stock. But the other source is the profits of the company. If you remember what net income is either paid to the shareholders as dividends or it is used as financing and is reinvested in the company. So the cost of common stock is going to be the rate at which investors discount their expected returns. And we're going to look at this from two sources: the source of new common stock or the source of retained earnings. So let's think. The constant growth model from the Gordon model assumes a formula that had the beginning dividend divided by the price plus G. This gives us a required rate of return on the equity of the company. And again, since we now know that the return and cost are the same, this R sub S is the cost of retained earnings using the Gordon model, using that model of the dividend growth model that we talked about previously. Now, of course, we can calculate the dividends, right? We can plug this into our present value calculation and to find the present value of dividends, right? So in this case, dividends started at $2.97. They ended at $3.80. So N equals 5. So this has a growth rate of 5%. And of course, we can plug that into our formula, if you will, to attempt to find, in the end, the growth rate of dividends. This would be the growth rate we get. So we can either do it in the capital budgeting techniques worksheet, or we could do it in the time value calculation, if you will. So there's a couple of ways, again, we can find the growth rate of dividends. So now we can plug that number into our formulas here. So again, this is a formula for the growth model, the common stock dividend growth model. As you can see here, we can calculate the required return. 5% is the capital gains, that's G. And for this particular company, if you plug in the dividend, right, you can ultimately solve for the expected return, which is 3.03%. So this is the overall cost that we would expect to pay for this company's dividends, for this company's equity as a retained earning. Now, another way we can find the cost of retained earnings is by looking at the security market line formula from Chapter 8 in our textbook. Remember, the risk-free rate is like a 30-year Treasury bond. Beta is published. The average rate of return on the stock market is somewhere between 10 and 11%, maybe 12%. We can plug that into a formula. In this case, for this particular company, it turns out that the required return is roughly around 13%. So how can we do this with this weighted average cost of capital model? Again, there is a section for common stock. So let's plug in the information we know. The growth rate of dividends is 5%. Price is $50. The risk-free rate 7. We had betas 1.5. K sub M, the return on the stock market we have is 11. And here we're given next year's dividend is $4. Now, many times we'll actually just know the beginning dividend and not the ending. In this case, in this problem, we're told that next year's dividend is expected to be 4%. So what this will do is then calculate the cost of retained earnings using the dividend growth model and the cost of retained earnings using the security market line formula. Now, these two numbers are identical in this particular example. They come out to be the exact same number. But in the after-tax costs cell, it's actually going to use the average. It will average these two numbers together to end up with the actual cost of the after-tax cost of retained earnings. So again, in this particular model, the first thing we have determined now, what is the cost of using retained earnings, using the profits that shareholders are investing essentially back into the company. What is that cost? Now, the other cost of equity requires us to issue common stock. And of course, we're thinking about issuing common stock. We now know that there is going to have to be an adjustment to the pricing mechanism, because if the stock is selling for $50 and you're issuing it, you're not going to receive a total of $50. So we're going to have to incorporate now this cost into our formula, if you will. So let's kind of go back and kind of review here, right? The cost of retained earnings is this R sub S. So R sub S is the cost of retained earnings. R sub S, that was just the cost of, or the return on common stock equity. And if we know that they are equal, so in this case, since they're both equal, that's that 13%. But when we think about issuing new common stock, we have to now think about net proceeds. So the net proceeds are a little bit different for stocks. We're going to have to cover all the other flotation costs from before, but now we also have something called underpricing. So let's think about why we might need to underprice the stock. If we currently have stock that trades selling for $50 and we issued new stock and it was sold to the public for $50, how can we get the public to buy the new shares and not buy the old shares? Remember, we need to get money. So in a primary market transaction, that's the only time the corporation receives funds. So we want them to buy our new shares, not the old shares, and we don't want them to buy from the old shareholders or other shareholders. We want it to buy right from the company. So there is this concept called underpricing. So we might have to drop the price $1, plus we may still also have to pay all the flotation costs. But the formula is the same as our discounted cash flow model from before, except the only difference is the numerator now is net proceeds rather than the market price. So in this example, we have flotation costs are $5.50. When you plug that into the model, the cost of new common stock changes to 13.99%. So it costs the company 13% to use retained earnings, and it costs 13.99% for it to issue new common stock. So new common stock is the most expensive way to finance the company. The cost of debt is the cheapest way to finance the company for two reasons. Number one, it is the least risky, but it also has the deductibility of interest, so the government helps pay some of that expense. So in our example here, we had the cost of dividends, or cost of debt was 9.45, preferred was 10.6. The two costs of retained earnings were identical in this case. And then here's the cost of new common stock. So those are the costs of the sources of financing. So the next step is talk about the formula, right? So R sub A is the weighted average cost of capital. The W's represent the proportions of money invested or used to gather these types of funds. And as you remember, one of our assumptions is that these do not change. We're going to hold those constant for right now. These then represent the costs, the after-tax costs of financing. And of course, when you start the financing, we now know that R sub R, the cost of retained earnings, is less than the cost of new stock. So when you start to gather money, we'll talk about this in a second or two, you know you're going to start with the cheapest sources first. So a couple of things we need to understand about this equation, if you will, right? First of all, it's always best to use weights in decimal form and keep the returns or the costs in percentage form. Makes the math easier, right? Again, the weights also have to be non-negative. They have to add up to 1, and they cannot be negative. And finally, the common stock equity weight, W sub S, is either going to be multiplied by 1 or the other, not both. So whichever one is the least expensive is where we will start. So let's think about this process. Here we have a company that has 3,265 bonds selling at $9.80, 14,554 shares selling at $55 of preferred, and 80,000 shares of common stock. So if we go by book value, here are the weights. The company has 69% of its financing is debt, 9% is preferred, and 22% is common equity. So that's a total of $4 million on the books. But we don't want the market value structure here. We don't want the accounting value structure. We want the market value structure. So we need to convert these sources into their market values. So how we do that, obviously you just take the $980 in bond price multiplied by how many bonds. That gives us this 40-10-50 split between the sources of financing. So now we have to take the next step. We need to plug those weights into our formula. And of course, we'll do that here by plugging in the market values. So when we plug in the market values, see, it doesn't exactly come out to be $8 million, but it's pretty darn close. 40, 10, and 50 is the split. Here are our after-tax costs from up above, right? Again, remember that the cost of retained earnings is an average. So in this case, without taking any further complications in the issue, when the company first starts gathering money, it's going to cost 9.83%. Now, somewhere down the line, they may run out of retained earnings. When they run out of retained earnings, the cost is going to go up from 9.8 to 10.3% because now they're going to start using new common stock instead of retained earnings. And again, we know that that is now more expensive. So again, we've already talked about this. We know we want to use market values because we're issuing this debt, right? So from a purely theoretical point of view, there's two things we want to ask here. Number one is, how do we do the calculations? And then which weights do we want to use? So could the weights be targets or could they be historical values? So what we want to do is we want to use target market value proportions. What is the goal of the company is to meet this specific structure. And that is that 40-10-50 split that we had when we calculated the market values. So now the next question is, now that we know what the cost structure looks like, when do the costs go up? So what we're looking for now is what's referred to as the weighted marginal cost of capital. As the company gathers funds, as it gathers more and more and more, eventually the cost is going to go up when it runs out of cheaper sources of financing. And the easiest one to think about, we've already talked about, is retained earnings. But we also could think about debt could go up in price if we borrow too much money. So not only do we want to know the cost when it goes up, we also want to know the amount of financing when it goes up. To find that, what we need is something called a break point. And a break point, you take the amount of funds available at a given cost and divide that by the capital structure. So in our case, if we said, look, the company has a 50% equity structure and they've got $10 million worth of retained earnings, 10 million divided by 0.5, then we would need roughly $20 million is where we would run out of retained earnings, and then we would have to issue new common stock after that point. So to plug that into our final calculations here, we're told that the company's been using for $2 million of retained earnings. That's what they're going to have next year. And they've also said, the bank has said, they'll give them $1 million, but at $1 million, the after-tax cost goes up. So now what we have is a more complete picture of the capital structure. When the company starts gathering funds, the first tier is 9.83%. If the company gathers $2.5 million, right, if they need more than $2.5 million, at that point the cost is going to go from 9.83 to 10.36, because we're going to be substituting the cheaper form of debt financing with this 7% new cost. And then, of course, if we need more than $3.9 million, roughly $4 million, if we need more than that, then we're going to switch to, now we're going to be using our higher cost debt. We'll be issuing our preferred stock, as we talked about before, but now we'll also be issuing new common stock. So this gives us a stepwise pattern, if you will. And we talked about this stepwise pattern when we talked about capital budgeting and capital rationing, and how ultimately we choose an optimal capital structure. So that's the end of our discussion on the costs of financing. So we know what it costs for each of the products. We know what the weights are that we're looking for. One of the questions that's left open from this chapter then is, how do we decide what those weights are? And that is a long-term financing question set for another video.